This is Paul Amery, editor of indexuniverse.eu and the Journal of Indexes Europe. Welcome to our webinar on getting best execution in the secondary market for ETFs. This webinar is sponsored by SPDR ETFs Europe and by iShares. I'm joined this afternoon by three speakers. Ryan O'Connor is Vice President of the Global ETF Capital Markets Group at SPDR ETFs. Slawomir Rzeszotko is Vice President at iShares Capital Markets, and Todd Hollander is Head of ETF Sales at Jane Street Financial Limited. Just a reminder before we start the main part of the webinar, it's very easy for all of you to submit a question, and you can do so at any time during the next hour. You click on the question mark icon on the floating toolbar on your web session. This will open a Q&A window in the lower right-hand corner of your screen. You may already be seeing that Q&A window. You can type your question into the small dialog box and click the send button, and we will then collect your questions and pass them on to the panelists during the second half of the webinar, which will be devoted to the question and answer session. This is what we are covering during the next hour. Much of the recent debate over ETFs has focused on structural issues. In other words, how ETFs are put together, how they differ one from another, how they're labeled, and whether certain structures are too risky. But all ETFs have one thing in common: they're designed to be traded. And how investors should trade is one of the most important things to understand when investing in ETFs. And that's particularly the case in Europe, where investors, unlike in the US, are faced with a number of exchanges, other trading platforms, a number of clearing and settlement systems. So we'll be asking our panelists to throw some light on that subject in half an hour. Before that, Index Universe has put together some slides trying to illustrate the key issues as far as secondary market trading is concerned. We'll look at what an ETF is, where ETFs are traded, and how they're traded. We'll look at how ETF liquidity is sourced from the underlying asset in the index being tracked, but also when ETF liquidity can differ from that of the underlying. And finally, we'll suggest some ideas on how to ensure best execution when buying and selling ETFs in Europe. Just a reminder, I'm sure most of you know this already, but what an ETF is: it's an exchange-listed fund that trades like a stock. It derives its value from an underlying basket of securities, so 1 unit of a Eurostoxx 50 ETF represents the 50 shares in the underlying index in the index proportions, as you can see. And the ETF value is linked to the value of the underlying via a real-time exchange mechanism. So you can exchange the shares in the underlying basket or their cash equivalent for the ETF, and vice versa. You can exchange the ETF for the underlying. And that takes place in both the primary and secondary markets. So primary and secondary markets for the ETF are illustrated on this slide. The key actor, I suppose, to pay attention to is the authorized participant in the middle. That firm, also called a market maker, but AP has a specific authorized participant, or AP has a specific legal meaning, and it's defined in a contract between that particular firm and the ETF issuer. That firm can exchange the ETF units for the securities in the index or for a cash equivalent, and that takes place in the so-called primary market for the ETF. And then in the secondary market below the dotted line, that's where traders or investors can transact in the ETF units themselves, either with firms that are acting as APs or between themselves. And as you can see, the AP has a pivotal role in the whole structure. This is how it works in practice. This is a chart taken from a recent BlackRock publication. BlackRock's the parent company of iShares, but you can see here that, first of all, I'd like you to pay attention to the top and bottom lines of the chart. And this particular snapshot is of one iShares ETF, a Eurostoxx 50 ETF, on a single day in July this year. The bottom line shows the weighted average bid price for the index constituents over the course of the day. And the top orange line shows the weighted average offer price for the index stocks. So note that these are the bid and offer prices for the index stocks, not for the ETF. The blue line in the middle is the mid price of the ETF, and the crosses are where ETF trades are transacted. And you can see that the actual trades in the ETF almost always occur, as you'd expect them to, within the what we can call the fair value band between the bid prices for the underlying stocks and the offer prices for the underlying. Occasionally they can reach the edge of that band, as I think there's a case at around 11:50 in the morning, another one at about 1300 hours. And when that when the value of when the ETF trade takes place outside that fair value band, then the authorized participant can step in and exchange ETF shares for the underlying units, or vice versa, in so-called arbitrage trade to bring the ETF price back into line with the underlying value. So that's how the primary market and the secondary market interacts. In fact, there's a basic misnomer to deal with when talking about ETFs, because although ETFs are exchange-traded funds, that's the definition, in fact there are two ways in which trades can occur in the secondary market. The first is, as the name of the funds suggests, on stock exchanges themselves. And there are good reasons for an investor or trader to want to trade on an exchange. First of all, you've got a transparent order book, you've got a central counterparty to guarantee your trade. There are standardized periods of settlement, but there are certain things to be aware of when trading ETFs on exchange. This is particularly true in Europe. First of all, the actual liquidity in the ETF may be understated just by looking at volumes on exchange, and that's something we'll come on to shortly. And obviously, investors need to have market access to that exchange, either themselves or, I suppose, more commonly, via an exchange member like a market maker. The other way of transacting is over-the-counter or off-exchange, and the reasons for doing this are typically that, particularly for larger investors, institutional traders, pricing can be tighter than on exchange. They get a better deal. There's the potential to handle larger trades, and of course, OTC tends to mean less transparency. That may actually be sought actively by an investor. They may not want to advertise what they're doing. OTC means dealing directly on a bilateral basis with a counterparty, so you may have a wider choice of trading partners, but that also means you have some counterparty risk, and so people need to monitor who they're dealing with. Settlement periods can be non-standard by design, and trades may or may not be reported, depending on the European country we're dealing with. This is a very interesting chart that came in a recent Deutsche Bank report. That this is how much of European ETF trading is taking place over the counter, or in other words, off exchange, as a percentage of all ETF trades. Now, it's worth remembering that we don't know the exact answer to this question, because these are only the reported OTC trades, and by definition, OTC trading doesn't have to be reported in certain markets, so the true figures could be larger. But you can see that I think it's commonly accepted that there are more trades, OTC trades, reported in Germany and in the UK than perhaps in other markets, and you can see that 60 to 70% this year of ETF trades in Germany have been off exchange or OTC, about 50 to 60% in London, and between 10 to 30% on the NYSE Euronext and Swiss SIX exchanges. So OTC trading is a significant proportion of European ETF secondary market. Let's move on to the nuts and bolts of ETF trading and start by talking about costs. You can get data on average bid-offer spreads from all the European exchanges. They publish it on their websites. And we've taken a random selection of funds here and used the data provided by the London Stock Exchange to show that using time-weighted bid-offer spreads for the first 9 months of this year and comparing those spreads to the management fee or the total expense ratio of the funds, the bid-offer spreads can be significantly higher than management fees. In other words, in the final column on the right, we've measured a round-trip trading cost. So we've assumed that an investor makes one purchase and one sale, a purchase at the beginning of the period and a sale at the end, and that takes place at the average spread over the 9 months. And you can see that as a percentage of the total expense ratio, this can be quite significant. So trading costs can be much higher than management fees if one were to execute naively, just taking the best bid or the best offer on the exchange at a particular time. And so making sure that you get the best means of execution is very important. What goes into the bid and offer price of an ETF, or what are the main components of the spread? This chart has been produced by market maker UniCredit. We can see several components that could go into making up an ETF spread, and this is obviously in addition to the bid offer spread on the underlying assets, which is not shown in the chart, but there are various elements that can affect the spreads that market makers quote. Those include brokerage fees, taxes, costs for hedging foreign exchange exposures, creation or redemption fees for the underlying ETF if they need to use the primary market, and of course there'll be a margin built in for the market maker's profit and loss account. So it's worth being aware that all these components can affect the spread of the ETF. This chart is taken from a recent iShares report, and it illustrates well, in my opinion, that the fair value band for an ETF price, which we've talked about already, can be much easier to define in certain circumstances than in others. If the underlying assets are liquid, let's say we're trading in a single time zone in the ETF and also in the underlying assets, they're all in the same currency, there's continuous trading in all those underlying stocks or shares, and then we're likely to get a diagram like the one on the left where you've got a clearly defined upper and lower bound to the fair value band. But in other cases, you can have quite high price uncertainty, and some of the causes of that high price uncertainty, which makes it difficult to estimate the higher and lower levels of the band, and makes them fuzzy, as you can see in the chart on the right, could be multiple listings or trading venues, could be multiple currencies for the trading and for the in the ETF and the underlying. Multiple trading time zones, and of course less liquid underlying assets. If you're dealing with less liquid areas of the bond market, there may be quite wide variety of differences of opinion as to what the constituents are actually worth. Let's look at a couple of examples. Here we've taken, been provided with a Bloomberg snapshot from a couple of days ago for the SPDR MSCI Europe ETF. It's traded on a number of different exchanges in Europe, and most here is perhaps not the most liquid European equity index, but it's one of the more traded ones, and most of the constituents of the underlying index are denominated in euros, not all of them, because I think there are some UK and Swiss stocks in there as well. But you can look at the quote, the bid-ask quotes on different European exchanges in Germany, Switzerland, France, and Italy, and a European composite, as well as I think another exchange there. And you'll notice that there's I've calculated the spreads in terms of basis points or percentages. In Germany, you've got the tightest spread at 18 basis points on this particular moment in time, 20 in Italy and France, and 23 basis points for the Swiss listing, which is actually in Swiss francs. So perhaps that slightly wider spread on the screen quotations reflects some forex conversion costs for the ETF market maker. If we look at a less liquid ETF, this is a SPDR Europe local currency bond fund that was launched earlier this year. This tracks an index of emerging market local currency bonds, in other words, bonds issued in the local currency of the emerging market countries concerned. I think there are 18 countries in the index, so you've got a lot of currency conversion inbuilt to the ETF, in the ETF price. And here it's interesting to note that, well, first of all, we've got different currency quotations of the same fund in dollars, euros, and sterling at the bottom on the London Stock Exchange. If you work out the spread for the different listings, the spread is tightest on the German exchange. It's just under 1%. It's 1.3% for the US listing in London, and it's 1.2% for the sterling listing in London. So it's worth pointing out that these are all listings of the same fund, but you can have, at least using exchange-based liquidity, quite different spreads. Let's explore the question of listings of the same fund in a little bit more detail. Here you can see 3 listings of the same Lixor fund tracking the Eurostoxx 50 index on the 3 largest European exchanges. LN is London at the bottom, that's the dotted line. FP, the dashed line, is the NYSE Euronext Paris listing, and the solid line is the Deutsche Börse listing, GY. You can see that for this particular fund, the NYSE Euronext Paris listing has got the lowest spread, at least based upon averages of spreads for this year so far. The UK listing, the dotted line, looks relatively untraded and has a higher spread as a result. If we add in funds from a second issuer, DBX Trackers, you can see that the German listing of the DBX Trackers fund is actually the more liquid one, and perhaps that's unsurprising. Most of the clients of that particular firm may well be home clients in the German market, and so most of the trading in that particular ETF goes on the local exchange. And we can add in iShares, two funds, one London listed, one German listed. Interestingly, the iShares German listing for this fund is actually more liquid based upon the spread data we've got here than the London Stock Exchange listing. So this points out that different listings of the same funds can be significantly different. And obviously different funds from different issuers on the same index can be different, so people need to pay attention to all these things. If we move to a slightly less liquid area of the market, we've got a corporate bond index, market iBox Euro Corporates. Two listings of a Lixor fund tracking the same index. Well, first of all, we can see that there's been a steady decline in liquidity in this particular ETF this year, which I believe reflects some decline in the underlying corporate bond markets. But you'll notice that again the French or the FP listing of the Lixor fund tends to have lower spreads than the German listing. Again, perhaps reflecting some home country bias. Lixor is owned by SocGen, a French bank. If we add in another ETF tracking the same index offered by Amundi, a similar difference between the French and German listings of the Amundi funds, with both slightly higher than the Lixor funds on a direct comparison. And here are two iShares ETFs also tracking the same index. We can see a similar trend, except interestingly for the London listing of the Euro Corporate Bond Fund, which is actually the largest corporate bond tracker in Europe. That's had some improvement in liquidity in September compared to the other funds, which have continued. Come on, you need to transfer the control. I've joined twice. You need to transfer the control.
You have to call in both the control.
I have. I've called it twice. I don't know why.
Oh, yes. Okay.
Okay, I hope everybody can hear me again. I'm sorry for the interruption. Not sure what caused. Let's move on to the emerging markets, MSCI emerging markets trackers. Here's a Lixor fund traded in France and Germany. You can see a similar trend with the French listing being more liquid. If we add in the DBX trackers funds, you'll notice that the German and the French listings have been more liquid than the London ones, and although the London one is actually for the DBX trackers fund has has proved more liquid in recent months, and for the iShares trackers, we've seen a similar development in September with the liquidity of the London fund being improving with respect to the other listings of the same fund. If we look at the one thing that ETF issuers and traders will regularly tell you is that you need to look beyond the quoted liquidity of the ETF and to the liquidity of the underlying assets when assessing the impact cost of your trade. This chart is taken from an iShares document and is based upon its Eurostoxx 50 tracker, which is one of the largest ETFs in Europe. On the 15th of July this year, an investor bought 2.4 million shares in this ETF, and that's equivalent to about 80 million pounds or around 90 million euros in cash value. If you had measured the impact cost of the trade by looking only at the ETF volume on the left-hand scale, then a 2.4 million ETF share trade would have registered an impact cost of well over 200 basis points or 2%. In other words, you could have expected to move the price of the ETF by at least 2% if looking at the historical data, trading data for the ETF only. If you look through to the liquidity of the underlying basket on the right-hand scale and the orange line, then a 2.4 million euro trade was in fact a 2.4 million share trade in the ETF, in other words, an 80 million pound trade, registered an impact cost of only around 5 basis points. So it's important to look at the liquidity of the underlying when measuring the impact cost of your potential ETF trades. At the same time, it is important how much trading volume goes on in the ETF. This chart from State Street, which shows a US listed fund of that issuer, its emerging market small cap fund, this shows that there's a clear inverse relationship between the trading volumes in the ETF since its launch. The ETF trading volumes are shown by the green bars and against the left-hand scale, and the spread, which is on the right-hand scale in basis points and shown by the orange line. And you can see that as trading in the ETF has taken off, the spread has declined. So the ETF trading volumes are also important. It's not just a question of the underlying. One needs to consider both elements. In certain cases, the liquidity of the ETF can actually exceed the liquidity of the underlying, what you might call this super liquidity, I suppose. In this particular case, we're showing the iShares FTSE 100 ETF, or ISF, which is actually the most traded ETF in London. On the left-hand scale, the mean bid-offer spread of that ETF over, I think, the 6-month period shown here. The mean bid-offer spread on the ETF is the dark blue shaded area at the bottom of the chart. You can measure it against the left-hand scale. It's been a mean of 4 basis points over this 6-month period, so it's a relatively tiny trading cost for this particular fund. If you look at the weighted average bid-offer spread of the 100 constituent stocks in the FTSE 100 index, that's shown by the orange line, then you're talking about a spread of 7 basis points. So the ETF is trading with liquidity that's greater than the liquidity of the underlying. In other words, you've got excess liquidity by trading through the ETF than when trading in the basket of the underlying. However, this is not always the case. You've got some funds that are super liquid, but you've got some funds that are relatively illiquid. And here we've shown a sequence of weeks on the London Stock Exchange during this summer when Euro market concerns started to become acute, and you can see we've put them in 4 bands. ETPs, on the exchange with spreads of under 1% over the week, others with reported spreads between 1 to 5%, 5 to 10%, and on the right-hand side of each 4 bars, spreads of even over 10%, which seems huge, but these did occur. And these are time-weighted average ETF spreads on the London Stock Exchange using the bid and offer tick prices from the exchange's order book. You can see that the number of ETPs on the exchange with spreads of between 1 and 5% actually trebled over a full 3 to 4 week period. And over the last week, when markets became particularly illiquid and Eurozone crisis concerns were hitting a peak, you can see that these 16 ETFs had spreads of over 10%. In one case, the spread hits over 100%, which seems quite extraordinary, but it was possible. And we'll see how these spreads came to be recorded in a second. They appear to have been caused by partial withdrawal of market maker support during the week. One of the funds in that table, the iShares Developed Market Property Yield Fund, on a particular day of the week of the 12th of ending the 12th of August, you can see its bid and offer prices over the day. You can see a decline in the price in the second half of the trading day. Times are London times at the bottom of the chart, and you can see during the second half of the day, or during the last 3 hours, on occasions the bid price of the fund, shown in blue, kept dropping to zero and then being reinstated. So why were the spreads so large for a fund like that particular one? Well, the time-weighted average spread data calculation from the exchanges uses all ticks, and during periods of market volatility, we can see that there are certain periods of maybe a few seconds or a few minutes when bids dropped away, and that caused, because of the way spreads are measured, it caused a jump in the spreads to 200%, because if the bid is zero and the offer is whatever it is, you're going to get a 200% spread. Now, in this particular case, iShares has pointed out that based upon a median of 1 minute average spreads, you're looking at a spread which for that particular week, which is much lower, of around 1%. And I think another question which is completely fair to ask is how realistic it is that a trade gets executed, but at a low price. Obviously, if there's a zero bid, you can't sell. So, but it's worth, I think, looking at what some of the protections that exist on European exchanges against what we might call mistrades. First of all, it's worth drawing some attention to market maker obligations on exchange. These can vary from one exchange to the other, but typically there's an obligation to maintain quotes within a maximum spread band, for example, 1.5%, 3%, 5%, depending on the type of ETF, above a minimum market size, and for a minimum percentage time of a continuous trading period, for example, 90% of the time. So there are periods when the market maker is not obliged to quote. And there are also some significant get-out clauses for volatile markets. In addition to these, the exchanges, we've looked at 3 exchanges here, have some additional safeguards. There are possible cancellations for mistrades, and there are volatility interruption or so-called circuit breakers, which we've given here in some detail, which can suspend trading if there's a move of more than a certain percentage in an ETF's price from either a static or dynamic reference point, or in the case of Euronext, from the INAV. And such circuit breakers have become an increasing focus in the US market since the flash crash, when exchanges have started putting them, I think, across the board on the ETFs. I think a key point to pay attention to here for European ETF investors and traders is that the rules are not uniform across Europe, and they may need to be standardized, but it's certainly worth paying attention to them if you're potentially trading on different exchanges. So, drawing things to some conclusion before we move on to the Q&A, well, what's the answer then to achieve best execution? I think it's fair to say that's a difficult question to answer, and I'm looking forward to hearing our expert panelists' views on this, but there's no single answer. There are certain things that you need to take into consideration. The listing of an ETF and its currency denomination are both important. They can affect the quoted spreads on individual exchanges. Some can be more liquid than others. Clearly, the time of execution is important, when you execute your trade in the trading day, depending on the liquidity of the underlying and when that's most traded. You can have some protection against mistrade by the use of limit orders, and we've heard it from some issuers that certainly less sophisticated investors should be using limit rather than market orders to trade ETFs. If you're measuring the quality of execution by a benchmark, you can use the NAV for the end of day fixing of an ETF's price, and indeed you can actually trade at NAV. You can leave an order to buy or sell at that NAV plus or minus a spread, or you can use the intraday indicative NAV or INAV as a measure of execution quality. And for larger institutional orders, many people use algorithms to source the underlying liquidity and measure the quality of their execution that way. And clearly there's a decision to be made for larger investors whether to go on exchange or OTC. We've heard over the last few years, I think, that people say there should be more exchange-based trading of ETFs, but at the same time, there's no sign, as far as I can see, that OTC trading is diminishing in importance. And looking forward, there's I noticed that the MiFID II review has been released today, I believe. I've seen a quick summary of results. I haven't had a chance to find anything relating to ETFs in there, but it's widely expected that there will be compulsory trade reporting of ETFs throughout Europe under MiFID II, so that's likely to improve post-trade transparency. At the same time, questions of market structure are extremely important. We're seeing a lot of exchange mergers mooted, and equally important, or maybe even more important, what's happening to the post-trade clearing and settlement infrastructure has a direct impact on what happens to ETF trading. There's increasing pressure for transparency of trading. We're seeing this across the market, not just in ETFs, and it obviously applies to the way ETFs are structured as well as the way they're traded, but we're seeing more and more demands for transparency. At the same time, it seems quite likely that fragmentation of trading will continue, certainly looking at how shares are beginning to trade on many different venues and competition amongst trading venues. It doesn't seem likely at any time soon that there's going to be a consolidation of liquidity in any single place. That's not necessarily a bad thing, perhaps, for investors. It means competition, but it gives everybody a harder job trying to keep up with what's going on and also trying to measure best execution. So with that, we'll move on to the question and answer part of the webinar. Please, we've already had a couple of questions in, which thank you very much for those. We'll be passing those on shortly, but please keep sending your questions in. And I have some of my own, which I'd like to start with, if I may. Ryan, perhaps I could start with you. How do you, I think you might need to unmute yourself, Ryan, but the question is, how do you assess the likely, you're an issuer of ETFs, how do you assess the likely liquidity of an ETF before listing it, and how important is it that an ETF is listed, is liquid when you consider listing it?
Well, I think there are a number of things that we end up having to take into account when we make the decision of, where we decide to list an ETF and how we go about deciding which exchange we're going to list on. The first thing that we always need to look at is based off of other similar type funds that are in the market, where liquidity traditionally has tended to aggregate, and I'd say that's probably the first and easiest benchmark that we use. The next that I try to frankly pride myself on, I know we really take a lot of time in understanding this, is from a market making perspective and the different market makers that are there in the market, what venues they believe offer them the best platform by which to supply that liquidity. Now, we've got pretty open dialogues with exchanges across Europe, and ultimately it does end up being a combination of the feedback of the market makers, where our clients are located and where those clients would prefer to see those funds trading, and then ultimately, again, the third point, which I originally made, which is competitive funds that are in the market.
Slav, I mean, what's your opinion on obtaining the best liquidity for the ETFs that are listed, and in particular, what number of market makers should a fund have? Is it important that a fund should have multiple market makers, and should exchanges perhaps insist on having multiple market makers? Because I think currently they don't.
Yeah, that's a very good point, actually. I think that experience shows decisively that funds with a higher number of market makers definitely trade with better liquidity, and also they are better protected against the instances where, as you demonstrated during the presentation, occasionally there is no bid or no ask in the order book. So I think basing the ETF provider model on the multi-dealer model, for example, is one way to try and make sure that the environment is crowded with market makers. But the other thing is also very important, that exchanges work with the members and work with the market makers to make sure that they are incentivized enough to provide liquidity on screen. And I think there are various concepts flying around at the moment, and exchanges try to look into that. But I think we will see some big changes coming up in the near future on how exchanges decide to organize that as well.
Could you elaborate a little more about those incentives and how those work? Because obviously exchanges have their designated market makers for particular funds. You, as issuers, have your own relationships. And there are lots of unofficial market makers who are just out there trading. How do you categorize those different groups of people?
Well, I think the visible group of market makers are those who are registered and are official liquidity providers with exchanges. And then obviously, I think those entities get visibility through the fact that they are registered with exchanges, but also they can rely on rebates in trading fees, sometimes in clearing settlement fees, as is the case in Deutsche Börse's example. So that really helps getting more market makers registered with exchanges. And in fact, we have seen more and more entities signing up to become official liquidity providers on exchanges recently. On top of that, I think ETF issuers try to work with the community of the sell-side firms, especially if, like in the case of iShares or State Street, these are ETF providers without their own sell-side attachment or investment banking arm, to make sure that the structure of products provided in the market offers competitive access for everyone, and various entities can compete against each other on exchanges.
Well, perhaps I could bring in Todd here. Todd, what's your perception of that? Is it important how an ETF is structured to the way it trades in the secondary market? Is it important if you know, whether an issuer has its internal desk or not? I mean, does that affect? Based upon the charts we saw earlier in the presentation, didn't seem to be much difference between a Lixor or a Deutsche Bank or an iShares Eurostoxx 50 ETF. They were all about the same in terms of spreads.
I think it depends a little bit on some of the products. It certainly depends on how they're structured from a market making capacity, but I don't think if an issuer necessarily has their own desk that's going to help. I think when you're looking at market makers and ETFs, I think the key is, why is someone wanting to be a market maker? What is their business model? Are they being a market maker because they truly understand the value of what they're trading and they want to support the product and do the arbitrage? Do they want to become official market makers and get exchange exposure just to get name recognition? And lots of times I see market makers, you know, there's quotes out there and they tend to just follow the exchange minimums, and as you pointed out, when you had those crazy times in August, a majority of the bids disappeared. So I think it just depends on what is the methodology and why does someone want to be a market maker. At Jane Street, our model is a floor-based model. It started in the United States. I started trading ETFs in 1993 on the floor of the exchange, where I was calculating a value and providing two-sided pricing to investors. And then I think as the market developed, another part of what happened in the U.S. was the retail, and the retail got more involved, which allowed more liquidity on screen, allowed the spreads to narrow. And there's many issues in Europe, and I can cite a lot. One thing I noticed is you pointed out in Germany, lots of times the spreads seem to be a little wider. That could be a function of the fact that settlement in Germany is T+2 versus T+3 in the rest of Europe. So lots of times a market maker, especially on the sell side, is going to price that in, because depending on where the product is trading and where the market maker has shares, because of the multiple listings of these products, if someone is long shares in Italy and sells them in Germany, that product needs to be moved over to make settlement. So sometimes that's going to get priced into the quote.
So settlement and clearing potential costs are priced into those spreads by market makers?
Well, I mean, it's definitely something you need to be aware of.
I think, Paul, just to jump in quickly, another thing from an incentive standpoint that you'd mentioned earlier, and I think Slav and Todd will both agree with this, is at the end of the day, traders make money off of trading, and that's kind of how they are incentivized to be a part of the ecosystem, if you will. And I think the most important incentive that I know we here at State Street focus on, and I'm sure the guys at iShares do as well, is making sure that there is the demand and making sure that we do see as much liquidity as possible on the screens, because as we see that, as was evidenced by the graph that we showed earlier for our emerging market small cap fund, as that trading volume picks up, as the incentives uptick for these market makers, that tends to be positive all around.
Right, but I mean, there's probably we're never going to see in Europe. I mean, please disagree with me, but we're probably never going to see in Europe spreads of the type that you have in the US for some of those funds, just because of the way the markets are structured over here.
Well, I think I can just chime in. I think they will tighten a bit. I think one of the things that I've noticed quite a bit is that a lot of the times the spreads from the current list of market makers are wide enough because they're going to be outside creation redemption bounds. So what happens is that if an investor wants to buy or sell an ETF that is going to be smaller than a creation and redemption amount where someone can go to the primary market and redeem it or create it, people are less likely to step in there because now you've got exposure. So if I sell 5,000 shares of an ETF, and I'm not actively quoting the product or actively involved in the trading of ETFs globally, now I'm short 5,000 shares of a product. I need to make delivery in 2 to 3 days. Where am I going to get it from? How am I going to do that? Right, because I don't want to sell 5,000 shares of a product and have to create 50 or 100,000 shares to make delivery and carry around all this inventory. So that's something I've noticed. There aren't many people willing to trade on smaller sizes, and since there isn't much of a retail market here, it's very difficult to have that supported right now.
Right. I'd like to move on to some questions we've had from our participants. One is a factual question, but which I hope one of you will be able to answer. Could anybody tell us what the percentage of OTC volumes is for all equity trading? What percentage of equity trading takes place OTC currently in Europe as opposed to on exchange?
Well, I mean, what I could speak to is the question more regarding what percentage of ETF trading is attributed to equity, OTC trading. Is that what,
No, I think someone wanted a comparison for how much equity trading is taking place OTC as opposed to on exchange, just as a point of comparison with ETF trading.
I could. Todd,
we can perhaps look that up and get back to you, the person who's asked the question. And I think I can answer the second question that person sent in about spreads. We've just taken the spreads data from given by the different European exchanges we quoted from, and I think they calculate spreads in slightly different ways. So I think in certain cases they're just using tick data, so there could be any volume on either or any volume of shares quoted at that particular spread. I think in the case of the German exchange, they use something called the Xetra liquidity measure, which is a measure of both spreads and depth of spread, which is a slightly more sophisticated measure. So we haven't strictly speaking been comparing like with like, but we were intending to show more trends and general levels rather than specific data. A question I'd like to pass on execution algorithms, perhaps to you, Todd. Someone's pointed out that execution algorithms such as TWAP seem very poor for ETF execution since they don't know how ETFs trade. What algorithms, or do you know of anyone in Europe specializing specifically in algorithmic trading for ETFs? And how, it was one of the questions I wanted to ask, to what extent are algorithmic trading programs being used in Europe for ETFs?
That's not really a part of our business since we're not in the execution business. I do believe that, talking to the investment banks, I believe they do use algos. It's a good way to try to target your trades to the benchmark or the NAV, as you had said earlier. What I don't really think works with TWAPs or VWAPs or things like that is that in Europe or even in the States, when you want to trade an ETF and you want a VWAP, let's say, you tend to want to do that most likely because it's an illiquid ETF. And if the order that you have is of relative size, you're going to become the VWAP anyway.
Right.
And I think that when people are trading ETFs, they need to realize that, they're not equities. It's not, IBM. and there's an underlying associated with it, and those things are going to move. And there have been many times where we've been asked for quotes on a product, and we've shown a price, and we think it's a very, very fair price, and lots of times the broker will say the client, just wants to wait, and then they come back later in the day and end up, sometimes paying more for it or selling it, for a worse price because they thought they might have known something. And I just think that, the last thing I'll say is NAV trading is very big in Europe. I don't think it's a very good thing, and I don't think it helps the market. There are risks associated with NAV trading, just as with risk trading. But when you trade on NAV, you do a trade, and especially if it's in emerging markets or bonds or whatever the case may be, you might not have your execution for a day or two, if not more. So you're exposed to all that risk. And granted, you're going to get your price, and you're going to know exactly where you're going to be filled. As you mentioned, this is usually quoted in NAV plus or minus basis points. But the beauty of trading on risk is you do the trade and you're done. And the other thing is that as NAV trading is so big in Europe, that's more trading that's not on the exchange, that's not getting reported. So it's actually taking away from the liquidity. And this is something that really does not happen in the States. And I think one of the reasons is clearly there is liquidity, but it all sort of feeds on itself.
So to summarize, you think people are assuming, I'll let you count on the sake, but so people, just to summarize what you said, you're saying that people think that they're getting a better deal by NAV trading, but they're actually exposing themselves to various risks that they're really not taking into consideration.
Yeah, I mean, I don't think they necessarily think they're getting a better deal from what I heard. I think it's just, it's a comfort level because they can, as you had brought up in your presentation, one of the questions is how do you know whether you got a good execution? And I think that's a very arbitrary thing. I think it's almost personal. You don't know. I mean, I think there are certain things you can do. You can talk to your brokers, you can talk to your market makers, you can understand the products that you're trading. But at the end of the day, I mean, whether you got a good execution is really how you feel about it. So I think lots of times people refer it to NAV because they can say, oh, well, this was NAV. I bought my ETF at NAV plus 15 basis points, so that seems pretty good.
Right. So someone wanted to comment as well. Was that you, Slav or Ryan?
Yeah, I just wanted to add very quickly a couple of things. I think the whole thing about NAV trading is really a testament to the flexibility of an ETF. So Todd is absolutely right that the product has been designed to be an exchange-traded product and has been designed to offer intraday liquidity. But one of the nice things about an ETF is that it actually offers you flexibility of doing the execution both ways. And I think it's very true that obviously NAV trading exposes people to a fair degree of market risk, depending on an underlying. It can be bigger or smaller, but sometimes people still elect to go this route because they just want to benchmark their investment for the performance measurement reasons. And the fact that ETF allows it is, I think, a nice way about the product, how flexible it is in adopting and implementing various strategies that people have. Now, on the algo use in trading ETFs, I would say everything is fine as long as the algorithm that is used for that is really an algorithm that is specific to an ETF or understands the way how ETF trades. You have mentioned in your presentation the mantra of ETF issuers and ETF trading houses about the underlying liquidity being the true liquidity of an ETF. And if someone is using a simple equity algorithmic strategy, he has to bear in mind that that strategy completely discards the whole primary market or underlying liquidity dimension of an ETF. And therefore, it's very easy to become the VWAP, as Todd said, or become the TWAP, and then chances of getting a good execution are smaller.
Can I ask all three of you to comment on the practice? This is a question from one of our audience. What practices may be used to get the best execution in lightly traded ETFs, or those that are less liquid? What's the best way of guessing that?
I would say.
To start with you. Was that you, Ryan?
Yeah, it was.
Yeah.
I would say there's a few things that are important. to keep in mind, especially with thinly traded ETFs. And I think some of the questions that we've had already have started to hit on them. The first of which is just, frankly, it's not as much of a tip as much as a be aware. You need to be very aware of, as you had referred to earlier, Paul, the depth of a quote. Now, we hear clients oftentimes talking about, what spreads look like, and they typically will quote that in basis points, which obviously is very important, and it's an interesting way to look at the cost of transacting an ETF. However, we do oftentimes find that there's neglect for the size of the quote, whether it's on the bid or the offer. So that's the first thing that we say is very important to be aware of. The next thing that we say, again, is already been hit on, but again, it's a very, very important point to make. It is understand what the differences are between limit orders and market orders. Depending upon what your kind of investment needs are and depending upon what your execution preference is, ultimately, you are looking at a limit order as a client if price is your biggest priority. On the other hand, typically, we find our clients looking at market orders who find immediacy to be their highest priority. Now, in the case of thinly traded ETFs, you need to be very careful, even if you do want to get your price done quickly on the screen. You need to be very careful about putting in market orders because of the fact that they are thinly traded, and if you look below the first few layers of liquidity, it could widen out significantly. So those are some of the things that we say about on-screen. Insofar as interacting OTC or interacting with a liquidity provider, that is really, as Todd had alluded to, up to the individual client and who their broker or AP of choice is. Now, my one piece of advice on this respect would be that you're dealing with counterparties who are experienced and knowledgeable in the asset class that you're looking to trade in. Now, ETFs, as we're all aware, trade like equities, but they have encompassed a number of different asset classes over the years. And there are many, many desks that are very, very good at what they do throughout Europe. However, not all of them are completely proficient across all asset classes. And the one point I would leave on this is that whoever you do tend to work with, if it's going to be OTC, make sure that they know and are proficient in that asset class in particular.
Any further comments from you, Slav and Todd, on getting best execution in lightly traded funds?
I would just add a little bit to what Ryan said. I mean, I think the two most important things, especially with thinly traded ETFs, are to work very, very closely with the issuer because, at the end of the day, they're the ones who came out with this product, and they presumably came out with it because there was interest in it somewhere. And when the products are being issued, there are certain market makers that the issuers will probably work with just to understand the levels of liquidity at that time. And then the other thing I think that's important in products that are thinly traded is just the risk appetite of the market maker or broker. Because I think that's a really big thing that defines the liquidity in a lot of these ETFs is that market making firms who understand the risk of the product they're trading and are a lot more willing to take that on are clearly going to have tighter spreads than others. So I think when you're talking about your Euro Stoxx 50 and your FTSE and your DAX ETFs where, there's tremendous amounts of liquidity, there's tremendous amounts of liquidity in the underlying, there's futures, a lot of those products are used for hedging, it doesn't really matter. But when you get into, some emerging market products and some fixed income products and maybe even commodity products, it comes down to the risk appetite and the comfort level of the market maker, and the better that is and the more understanding they have, the better they're going to be able to show a good price.
Slav, any further thoughts on that particular topic?
Yeah, I think obviously to Todd's point, I think responsible ETF providers try to do exactly that, try to understand where is demand and try to offer their clients services around execution that try to identify ways of getting liquidity even in a less liquid underlying exposures. Right. To the point about getting immediate execution, I think even then going and using limit orders is probably the safer way of executing. A limit order set in a proper way, in a less aggressive way, can still ensure quick execution. But
I would agree. I would never, I don't mean to cut in, I would never do a market order. I just think that there is absolutely no benefit in that whatsoever, and only bad things can come of it.
Todd, a question for you. Why are so many orders still done OTC in Europe?
I mean, I think it's probably, you know, mostly due to just a lack of liquidity or a perceived lack of liquidity. You know, I think that over the counter, you know, to me, over the counter works because it's price discovery. It's almost, you know, from my background, it's the old method of trading, you know, where you had one place to go. That's where everyone had to go to execute a specific trade in a specific product, and there was negotiation and conversation. You know, I'm not saying that's the reason, but I think that's certainly a good reason for it. And just as has been discussed here over the last hour, you know, you look on the screen, there's not much liquidity as you can visibly see it. Because you have multiple listings of these products, the spreads tend to be different on different exchanges, as you had pointed out. And lots of times, if, you know, a customer wants to trade in Germany, but the spread in Italy seems to be tighter, you know, they might be able to talk to a market maker who's covering the German line and say, hey, look, you know, this is where it's trading in Italy. I'd really prefer to trade it at the same level in Germany. Is that something you can do? You know, as opposed to just going and taking the offer in Germany and possibly paying more than you would without some sort of discovery.
How long is it going to take for all ETF trades to be printed in Europe, as we keep hearing is on the way? What's the latest?
I think, as you had said, you know, it's hopefully going to be in MiFID II. So it's just a matter of when is that going to be finalized and implemented. And I do not know that.
Any opinion from the issuers on the panel?
I would say from our perspective, the way that we look at it is there's two different issues. It's the pre-trade environment and the post-trade environment. And when we talk about the pre-trade environment, we're talking about, as Todd and Slav had both alluded to, as did you, Paul, in your presentation, multiple exchanges, multiple volumes on those exchanges, potentially significantly different spreads. And the issue is whether or not we can combine those all into one, obviously, piece of liquidity, which is a much more complicated and a longer term, I'd say, project, if you will. Now that's one. On the post-trade side of things, I would say that that's hopefully going to happen, as Todd had alluded to, in a much shorter period of time, which, you know, I know from our perspective, we're hoping that happens sooner rather than later.
And any, perhaps a final question from me, what about the policy of listing funds across Europe? Are we going to see any change in that? It's up to now, most issuers have just tended to list and then cross-list wherever they can. Is that still going to be the policy? Are we going to see people trying to concentrate liquidity in a few listings, or even one listing for individual funds? How do you see that evolving? Slav, I can ask you that.
I think it's obviously it's a trade-off between marketing exercise of having listings in every location where clients are targeted and getting the liquidity into one place. And I think issuers, by and large, have become more sophisticated about their choice of how many exchanges they would list their product on. Gone are the times with most issuers where every single new fund was cross-listed on any exchange that had an ETF segment in Europe. And I think it also, what helps and what will help in the future is the improvement in the trading infrastructure, so that clients in the Netherlands have fair access to instruments that trade in Germany, for example, or clients in Italy can access things on London Stock Exchange without paying an elevated premium for that privilege of that access, if you like. And I think within the framework of European Union, that's something that will be happening more and more. And then there's the investor education question. So the fact that I think the ETF community needs to do more work on educating clients using the products about the fact that listings are fungible, that it's the same product irrespective of which trading line is traded, and that liquidity is really can be focused in one market.
I think that brings us to the end of our allotted time. I'd like to thank our panelists for a very interesting discussion. I'd like to thank all of you listening in for bearing with us while I got disconnected earlier in the hour and for not heading out for a cup of tea. And we look forward to welcoming you to our next webinar in November. Thank you very much.
Thank you.
Thank you.
Thank you.